Hey everybody, my name is Eric Wilkinson. One thing I mentioned at the beginning of all of these webinars is watch this again. Yes, this is being recorded, and watch this again, I guess is how I should put that. The reason why we're recording this is so that you can go back and view it again, or if you missed part of this webinar, that you have the opportunity to see the whole thing through. But the thing that I really am pushing is that you guys go back and watch it again. And the reason why is because if you're newer to trading or you're newer to the way that I teach these different strategies, then some of the nuances that I'm talking about might just go right past you the first time. Second time through, some of those nuances will stick into your memory and it will last a lot longer. You will learn it rather than memorize. And the difference between learning and memorizing is memorizing comes and goes. When you've learned it, you will remember it for a much longer time. Okay, so please watch this again. We're going to be sending this out to you relatively shortly after. It's going to take me a little while to compress it and do all of those things. So hopefully we can get this out to you in a timely manner. But yes, please watch this again. All right, this is on our bullish bias. One of the things that we're doing with this webinar series is we come up with a bias. It's something we do every single day already, right? We look at the charts, we're looking at different underlyings, and we come up with a direction, an assumption we believe this market is going to go in for that underlying, or whether it's an index, ETF, or anything, okay? It can be futures as well. But we've come up with a bullish bias. So we want to take advantage of this by creating a synthetic long stock. So we're going to go through this using our bullish assumption in XYZ stock to come up with what we find is the best strategy, and ultimately it's going to be the synthetic long stock for this one, all right? So that's the idea, to try to build out a strategy according to our assumption in this series, okay? So I've gotten a little ahead of myself that we're using the synthetic long stock and that we have a bullish bias, but I want to preface that beforehand and then kind of go through our steps on a daily basis to figure out how we narrow all of this down. But let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. I've been trading my own money for about 25 years now. I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to teach you how to take control of your finances and manage your own risk. Like I mentioned, I started out trading in college with a psychology degree, though. And once I realized I really liked this trading, I decided to switch it over to finance. And after graduating from finance, I moved straight to Chicago to start working at the Board of Trade on the floor. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. I stopped short kissing the Stanley Cup there, just slightly short of that. All right, let me get over this real quick. It says any opinions, news, research, or analysis, or other information contained in this webinar or material provided by ProTrader Strategies and or associated companies or employees is for general commentary, you guys. What this says is basically I'm here to teach you guys how to swim, not to swim for you. I don't know what's in your portfolios. I don't even know what your risk parameters are. So there's no way that I could come out with a strategy that fits your portfolio specifically unless I knew all of those things, your risk parameter, what's in your portfolio ahead of time. So what I'm doing is trying to teach you with this webinar. We've come up with an assumption in something, and your assumption might be different than mine. It doesn't matter. Whatever your assumption is, we have a strategy that will fit all of the parameters in and around that. The environment. Is it the right underlying? Can we even trade it? Is that underlying optionable? Does it have optionable contracts where we can trade those? And I go through all of those steps throughout this. And real quick, you can follow me on Twitter at Wolfman's blog or our parent company at ProTrader Strat for all kinds of market wisdom and or snark out of me, most likely. All right, so options 101. Before we get into anything, I want to make sure you guys are clear of concept on these Greeks. And a lot of people start shying away real quick when we see the Greeks because what do all these things mean? I mean, it's Greek to me, right? So I've got some easy ways to remember what these Greeks mean. Now, unfortunately, we're going to have to start out with delta, and we have to just memorize delta. But delta affects an option premium in relation to the underlying's first dollar move. So what we can do is we can pull up the option montage here, and let me slap this up here. This is the charts. We go over to the trade area. This is the option montage, okay? So what we're trying to do is figure out what delta does. Delta tells us a lot of things, and I have a bunch of webinars on this, floor trader hacks and things of that nature that will give us all of this information relatively quickly. So if we are in this option montage, we want to go to the monthlies that are closest to expiration for the most part to check all of this stuff. So we look over here at delta, and what this is telling us is that XYZ stock here that we have is going to change in relation to the first dollar move. That's what delta tells us, right? So the 290 strike, once we see that XYZ starts moving, that's when we need to make our move, right? So if we come over here, let me find my pen real quick so I can play around with this. So if we find right here, we've got delta, it's 50, and our underlying is trading 289.87. So what we said with delta was the premium is affected by the underlying's first dollar move. So when this goes from 289.87, now we're 290.87. Let's say that it went up by $1, okay? So now we're trading at 290.87, right? This means that the 290 strike right here is currently trading, let's just say 385, okay? 385 plus the 50 on that first dollar move, because we've gone from 289, which our pricing is right here, to 290.87. So delta adds in to this premium. So we go from, let's just call it 385, add in 50 cents. We are at $4.35. So it'd be basically $4.35 for this one, and $4.38 on the offer. Okay, because it's gone up by 50 cents on that first dollar increase. Okay, that's what delta tells us there, is it affects the premium in relation to the underlying's first dollar move. All right, so we've got that. And it doesn't want to shrink for me. So delta is that 50 cents goes into that first dollar move. Gamma is a little bit different. Gamma here goes with delta. So we can easily say that gamma goes with delta, okay? So basically this is on the second dollar move, on a $2 move, okay? So now we pull up our platform again, and we can pull this out real quick. Pull up our platform. Let me pull that out so we can get rid of. So gamma here will tell us that on the second dollar move, gamma is the rate of change to delta. So this 4 cents here on the second dollar move gamma goes with delta. So now on that first one, we were at $2.90 and 85, right? That was on the first dollar move. That was on one. Now we have a second dollar move. So now we're at $291.85. Okay, so we've moved $2. So on that second dollar move, here we said delta added in, and we had 435, right? 435 on that first dollar move because we added 50 cents in. Now gamma goes with delta. So that second dollar move, we're going to add that in. So it's 54 cents. So now on the second dollar move, we would have a pricing of $4 and what did I say was adding in 54 cents? 89 cents. Okay, because it's 54 cents added in here. So we got to put in that 54 cents. Okay, because gamma goes with delta on that second dollar move. All right, delta is the first dollar move. Gamma is the rate of change to delta. So on that delta, we are on that previous one, we had 50 cents for the first dollar move, right? It was 50 cents there. And then we had 54 cents because gamma was 4 cents. All right. So gamma goes with delta to that 50 cents on the second dollar move. All right. So gamma goes with delta. And then we have theta. Theta is just time. It's as simple as that. We've got time here. So theta, think of it as time. All right. So it's the impact of time on the premium. So when we pull up our platform again, and we can look at the option montage here. So earlier we had the delta, and then we had the gamma. Now we have theta. So theta is time. So every day that goes by, the time of day, right? Theta is time. So every day we lose 6 cents out of our premium. So tomorrow, when right now we're trading at 388. Tomorrow, if nothing else changed, we still stayed at this pricing and the volatility stayed the same. All of these things remain equal. We lose 6 cents out of this premium. So tomorrow we would expect this to be $3.82 tomorrow if nothing else changed. We just lost theta coming out. And theta affects the premiums as well over here, right? If nothing else changed, we're losing 5 cents a day in premium. One thing I did mention, or forgot to mention actually, is that over here, if we look at delta, it's positive for the calls and it's negative for the puts, all right? The reason why it's negative for the puts is because everything's assumed that the market's going to go up. So if the market goes from 289 right here where we have the 289, okay, and it goes to 290, just like we were talking about before, it goes to 290.88, right? So it goes from 290.88, we've gone up by $1, it will decrease by $1 on the premium. And vice versa, if we went from 289 to, let's just say it was from 289 to 288, right? It goes now 288.89. So we've gone down by $1, all right? We've gone down by $1. Then a negative, we've gone down by $1, a negative plus a negative on the gamma is a positive. So if we went down by $1, then our premiums would increase. If we go up by $1, then our premiums decrease. Gamma still goes with the delta. Those two still go together. It adds in on a positive. It's going to make that on the second dollar move. We would be looking at 51 cents here, right, on that second dollar move. All right. So it still adds in and still affects those premiums. You know, the way if we went down by $1, those premiums would increase. Okay. And then finally, we've got Vega. And Vega is the rate of, or is the measure of change in volatility. That's pretty simple. We can look at that pretty easily by pulling up our platform here. And we've got volatility over here on the side. Whoops, I don't want that one. I want that one to be gone. Quit messing with me. I want that one. You're not going to let me get rid of you now? Sorry. Get rid of all of these. For some reason, now that I'm using this one, it wants to pull up. It wants to be a part of the party, you guys. So, Vega. We've got Vega over here on the side where we got it right here. It's also part of the calls. Now, what Vega tells us is it's the measure of change in volatility. All right. So, as this increases from 1248, now we go to 1348. It increased by 1 percentage point. All right. Now, this premium that we were talking about, the 289s, that premium gets added in because we went up by 1 percentage point, okay? Went up by 1 percentage point, so now volatility adds into here. So it'd be somewhere around 298, you add in 35, we would have a $3.33 premium there, okay? Now, if we were to go and see volatility decrease, Now it decreases to 1150. It went down by 1 percentage point. Then all of these premiums would decrease, right, by that 35 cents. So 35 cents coming out of there, we're going to have something like, $2.70, what is that, 72 cents or something, 73 cents. Okay, so we've decreased, actually it's a lot more than that. 63. Thank you very much, Jerry. 263. So it would go down. Vice versa, this premium over here with the Vega would affect that for any percentage change in the Vega. Okay, pretty simple. So Vega is just volatility, how this coefficient affects the premiums. All right, so now we got the basic 101s out of the way. So we know what the Greeks are. They're pretty easy. We've got delta, which is the change of the premium. Gamma goes with delta. Theta is just time, and Vega is just volatility. It's those percentages. Pretty simple. So throughout the day, we're pulling up charts, and we come up with a direction. What direction do you think it's going to go? Well, let's just say right now, we've come up with a bullish market assumption in XYZ. That's the only place we've gotten. We've looked at a single chart. It was Johnson & Johnson or something like that. And all of a sudden we are pretty darn bullish in this. We have to figure out whether or not we can come up with a strategy that fits everything. Now I'm going to lead you down the road to finding the synthetic long stock, okay? But all of these things that we go through with these rules are going to lead us to that final outcome. All right. So how do we build this synthetic long stock? Basically, it's pretty easy. We're buying an at the money call and then we're selling an at the money put. Okay. Pretty simple. It doesn't get too far away. ATM is at the money. So the major thing we want to do here is try and create 100 deltas. We want to get 100 deltas out of this, all right? Adding it all up. Now, a stock, XYZ stock, let's say XYZ stock is trading at $50, okay? And it goes up to 51. That basically is equivalent to 100 deltas, because everybody's assumed that, we have 100 of XYZ at the price of 50. All right. So if it goes up by $1, that's 100 delta. All right. If you only had 50 stock on, then it would be 50 delta. If you had 1,000 stock on, then it would be 1,000 deltas. Okay. But it's all assumed that when we're talking about XYZ stock, we're working in increments of 100. Okay. So we are looking to build this out to where we have 100 deltas and make that equivalent to 100 of the underlying, okay? Now remember, one thing with options is a one lot is equivalent to 100 of the underlying, okay? Don't forget that. All right, synthetic long stock is great for oversold stocks, right? We get a market that starts, precipitously going down. Maybe you were like, okay, that's 1, 2, 3, 4, 5 moves down. Now we've got an A, B, C move up, right? So that's maybe what we're looking for. We're looking for that bounce higher and trying to catch that. This could be like a 10% move or however you want to gauge your move. Maybe it just came down to a Fibonacci and this is like the, the 23 or something like that, and you find that it's going to bounce off this and you think it's going to rally to a new level. So it's great for oversold stocks. It's also great for the bullish assumption. Obviously, I kind of let that cat out of the bag right away. We need to have the bullish assumption. We can't get away with not having this bullish assumption going forward. Or just a bullish trending market. I showed you we were looking at something that was maybe a correction. Now we just have something that has already bottomed and we're looking at it just being in a bull market, which we're seeing a lot across the board right now is this bullish market continuously. So that's okay as well if we think it's going to continue this bull market. And for smaller accounts, all right, we are going to use a lot less margin trading this. If we were to look at XYZ stock, okay, if I had 100, the stock XYZ is at 100, okay, and I want to buy 100 of those. Well, most portfolios are, or most brokerage firms are going to make you buy that stock, and it's going to cost you $10,000, right? Well, with the options, I'm going to be able to get that same $100 stock for $2,500 using options. Okay? Yeah, some of you guys may have a brokerage firm that lets you out for 50% of margin. You're still using $5,000 in margin though up here, and I'm still only using $2,500 down here. There are some negatives with the synthetic versus the long stock, like, you're not going to get dividends and stuff like that. But I'm putting out $2,500 less. So you can see a portfolio of even just $10,000, we can be more diversified 4 times over here, right? Or I can increase my size. If I have a big portfolio, maybe I want to increase my size in a certain underlying. Maybe I'm looking at it like that the underlying, I'm used to trading stocks that are all around, let's say it's $100 or something like that. All my stocks I like to trade are $100. Now all of a sudden, I'm looking at a $300 stock. Well, if I did that by a $300 stock 100 times, well, now I'm heavily weighted over here, right? Well, with this option strategy, and it won't cost me anymore, I could maybe do the $300 stock only 50 times. Okay? And I'll show you how to do that. So then it's not overweighting my portfolio to this $300 stock. And I'll show you that. We're going to be able to create a more diversified portfolio using this strategy here. Okay? And it's great for newer traders. Why? We have a higher probability of success, and we aren't worried about a big loss here, right? With the XYZ stock, we put up $10,000. That's in the back of our head. When we're putting up the margin for the synthetic long or synthetic short, yeah, we're able to create a much more diversified portfolio. Therefore, we're hedged better. Okay, that's where we're increasing our probabilities of success, creating a more diversified portfolio. All right, and it's very simple to see how these options work. All right, one thing with the synthetic long stock is our risk reward is the same as a long stock position. Remember, I said if we do XYZ stock, I'm just going to how do I get rid of this thing? If I'm going to do XYZ stock, maybe I just move this out of the way. XYZ stock, our risk reward is the same, right? I talked about this. For every XYZ stock goes up by $1, if you had this as the underlying, it went from $50 up to $51. Well, we make that dollar. Same thing with this position. It goes up by $1. We're going to be able to capture that dollar. It does get a little out of whack, yes. Herman, you're right. It does get a little bit out of whack the deeper those calls go into the money. We're going to lose 1 or 2 deltas, okay? So we're going to lose maybe a penny if this has gone up by maybe $20 or something. We're going to start losing a penny for every dollar. I don't care about that so much, right? I would rather not deal with the heavy margin requirements with the stock and not deal with and not get the dividend in order to cut my outlay of money for this strategy and get the same dollar for dollar move higher, okay? I mentioned this. Uses about 75% less capital. I threw this out there earlier. That's when you're doing a $100 stock 100 times versus mine. It's, a $100 stock 100 times is going to cost you about $10,000. Some people can get it down to about $5,000 if they have worked it out with a brokerage firm. But with the options, you can almost never get a margin requirement that's going to be, half of even that. So 75% less capital requirements from a regular stock position. And when we use less capital and our return is the same, remember we were talking about XYZ stock, XYZ again. We've got XYZ stock trading at around $100. And originally I go out and buy this and it cost me $10,000, right? Well, XYZ stock goes up by $1 to now 101. So now the stock's trading 101 on that 100 contracts because we only have 100 contracts. My positions increased by $1 or $100, right? So on 100 contracts, cost me $10,000 to put up for this XYZ stock. It goes up by $1. I've captured that dollar. But that dollar increase is based on this $10,000 I had to put up for it. I told you with the options, we do a call, we buy a call, we sell a put, all right? It's only $2,500 in margin. And I still get that dollar increase when it goes up, right? My position still increases by that dollar, just like it increased by $1 here. Only $2,500. So my return on $2,500 is this dollar. My return on $10,000 up here is this dollar. So the return on capital is better down here. All right? Right down here. Getting a little crazy with my marker, sorry. But you can see that's why the return on capital is much better using these options. Building a synthetic long. We talked about this. We are going to try to buy this as a 50 delta. And we're going to sell this one. Remember, it's a negative delta. All right, so we're going to try to do that one. Sell a negative makes that a positive. So you add those up and we get 100 deltas. All right. The other thing you can do, remember I was talking about if we had a stock that was like a $300 stock, we didn't want to do 100 contracts. Well, if you did the 25 delta here and the 25 delta here, it's also called a risk reversal. Yes, Mary got that. We've got a risk reversal going on, but we only have 50 deltas. All right. So if we only have 50 deltas and XYZ goes up by $1, it increases by that dollar, we only increase by 50 cents over here. All right. It only increases by 50 cents. Why? Because we only have 50 deltas. And think about it. If you had XYZ stock and I only bought 50 of them, if I bought the $100 stock 50 times, right? Okay, and it goes up by, this goes up by $1 to 101. Well, I only own 50 of them, so I only increase by $50. Okay, so that's the same as if I bought a $100 stock 50 times and it goes up by $1. My position only increases by that 50 cents. Okay, so it's the same thing. We're just playing around with it a little bit different. So if you want to do less contracts, like half as many, you're using a big stock, or you want to just test this out with less contracts, then go to the 25 delta. It's going to call it a risk reversal. That's fine. But today we're going to try and build it out to be equivalent to what the underlying is doing. All right? So that's how we build out the synthetic long stock. Now, pretend that we're forgetting about knowing we're doing the XYZ stock, right? And we're doing the synthetic long. All right, so keys to success is picking the right underlying. Now, how do we know if we're picking the right underlying here? Well, we have to go to the option montage. And my rule of thumb here is any stock that is over $100, we just move the decimal place 1, 2, 3 places to there, and now 29 cents is how wide we should see between the bid and the offer. You can see here it's only 0.03 cents, okay? But my extreme level would be 29 cents on an underlying, okay? So Any stock over $100, move the decimal 3 ticks to the left, come up with how wide our bid offer should be. Should be inside of 29 cents. You can see SPY fits that rule nicely. Any stock under $100, then we want, during open market operations, we look at the closest to expiration, all right? So we have all of these weeklies, we have these monthlies out here. So during open market operations, we are looking to the ones that are closest to 35 days to expiration, all right? And ATVI, which is Activision, we look at it, it's under $100 stock. So any stock that's under $100, all right, it's less than $100. Any stock less than $100, then we need our bid offer to be less than 10 cents wide, okay? And so you can see 72 to 75, it's inside of 3 cents again, okay? So that fits the rule. If it's outside of that, especially when you get up into the multi-$100 stocks or whatever, we can go back and look at something that's priced a little bit higher, IBM. IBM's 10 cents wide, but we would expect it if we moved it 3 ticks to the left, 1, 2, 3, that our options should be inside of 14 to 15 cents, okay? On a stock, you can, and this is a green light. We call this a green light. I probably should have yelled or threw that out. If it basically, on a stock that is, should be 14 cents wide, if you basically threw a nickel on there and it was a little bit wider, then we got the yellow light, okay? So if it's outside of those parameters by about a nickel, then we are looking at a yellow light. You get too many yellow lights, we forget about it, all right? So that's our rule there. Too many yellow lights, we push it. So stock over $100, 3 ticks to the left. That's how wide the bid offer should be and the closest to expiration. That's where the most time and volume is being spent. That's where the eyeballs are. That's where everybody's looking. So if I bid 361, somebody might come in and offer 369s to try and better the market. That's free market price discovery at its best. And you see that come up the most often when we are in very robust underlyings, okay? So that's picking the right underlying. Is any stock over $100, move the decimal 3 ticks to the left. That's how wide the option montage should be. Any stock under $100 should be 10 cents or less, okay? It's pretty simple there. And then we move on. Picking the right environment. Well, the beauty in this one is we don't have to worry about the environment as much, because remember when we did this, let me get rid of some of this stuff so it's not as in your face. Okay, let's look at Tesla, see if it's the right underlying. 3 ticks left, 26 cents wide. We can see that it fits that rule of being inside of 26 cents wide to the bid offer during open market operations closest to expiration, all right? So that underlying we would know is right. One thing about the environment is I talk a lot about the environment being in regards to implied volatility percent, okay? And the reason why I talk about the implied volatility percent a lot is because it tells us where volatility is in relation to where it's been in the past. So if it's way up here, we want to sell premium, okay? Because as volatility comes out, remember, we said as the premiums come out and those percentage points start decreasing, we're able to see volatility, a big number coming out for 1 percentage point move. And if we go over to the chart, we can see that these percentage point moves are going from basically, let's say 80 to 50. That's 30 percentage points. 30 cents a percentage point is a lot of money to see, even if the underlying, say for instance, we sold calls, the market, the premiums coming out of it, we can be directionally right, but all of that volatility coming out of those calls is helping us, all right? So that's a good thing when we're talking about with options. But with this one, because I am buying, I'm going to buy volatility here, right? So if I buy this option which is the 270 strike. Let's go to the closest at the money. So we're looking at the 265s. If I buy this premium here, my volatility vega is 32. So as volatility increases, this premium will increase by that exact amount. All right. If I sold this one and it increases, my premium is going to be affected as well. All right. So as I bought this one and premium increases, that helps me. As I sold this one and premium increases, that hurts me. But they're offset by the same amount. If this goes up by 1 percentage point to 74.44, right? We talked about this. This premium right here is going to go up by that 30 cents, right? So we've gotten that to now 1907, right? 1907, because it's increased. I bought this. That increase helps me. I sold the 284s. This is going to increase by 30 cents. It increased to, what is that? $18 and 12 cents. Okay. So as this helped, I bought those and sold those. This hurt me. I lost money here. I made money here. They've offset. So we've offset the volatility. We don't have to necessarily worry about that environment. Having said that, because I have strategies that work so much better with this high volatility up here, okay? I've got strategies that work really well with implied volatility when it's at extreme highs. I've got strategies that work really well at extreme lows, okay? This one I like to play around with when I'm not really sure about where volatility is going to go. And when volatility is right here, kind of middle of the road for this XYZ, we don't know if it's going to go up or down. It kind of wants to migrate to those points, just like a chart, and we get up and it acts as support. So the idea is it wants to come back down to the median, or kind of like what I talk about, wants to come back down to the point of control and stuff like that. We're going to see the markets have its extreme highs and extreme lows. For Pepsi, a relatively low number, maybe 17, but for something like what we're looking at with what was Tesla, I think it was, is this one Tesla or Biogen, we can see that it never gets as low as 17. So every underlying's implied volatility is different, but they do have a tendency to have their own ranges, kind of like a stock. Like Biogen's not going to go very often above 400, or it hasn't, and not going to go much below 200, but it stays within those ranges. We see volatility do something very similar with that as well, okay? We're going to see it have its ranges. And implied volatility percent is pretty simple calculation. We can take where it is currently, 32, subtract it by the low, which is 20, and then you divide it by 45, the sum of the 45 minus the low. So let's pull this up. Basically, we would take where it's currently at, which is 32. So we take this fraction. Give me a pen here. So we got a numerator and a denominator, right? So we take 32 minus the low, which is 20. Remember, we got this as the 20. And then 45 minus the low. Whoops, 45. Let me erase that if I can. So 45 minus the 20 in the denominator, right? So numerator, where it's currently at, 32, minus the low of 20, and divide that by the sum of the high, which is 45, minus the low of 20. All right, so we have in the numerator 12 divided by 25. So we could say for ballpark purposes, it's very close to, I'd say probably 47%, right? If it was 12 and a half, would be right there at 50, right middle of the road. That would tell me I don't know what direction it's going to go. You know, 50, we look at 50 as middle of the road. It means it could go higher and it could go lower. But when we're at these extremes, like if it was at 20, I would say it's going to go higher. And if it's at 45, I know it's probably going to go lower. But 50, it's a pick 'em. That's why this is a great strategy for right around the middle of the road. I have better strategies for low probability. I have better strategies for low implied volatility. I have better strategies for high implied volatility. So picking the right environment, if it's middle of the road, we're going to be going towards the synthetic long stock or something very close to that where we can offset a lot of these Greeks, right? Because I'm buying the same strike and selling the same strike, I'm, like I said, able to offset the volatility. 28 here, 28 there. So every change in volatility, those are offset. Well, something else is also offset. It's going to be very close, is the theta. We aren't going to have to worry about the theta too much as well. And or the gamma, because we're buying and selling the same strikes. Okay, so a lot of those are going to be offset with this strategy, which is the beauty in it. May have gotten a little ahead of myself there with that one though. And picking the right duration. Well, if we are going to be looking at duration, one of those things I just talked about was getting rid of the theta, right? If we are, theta is a negative, and I bought this one, so I'm long $7.80 here or whatever. Every day that goes by, I lose 14 cents. Well, if I sold these same strikes over here, and every day that goes by, I lose 12 cents, then that helps me. These aren't exact. It looks like I'm gonna lose a little bit more on those calls, but it's only 2 cents. We're not worried about that, right? We're not worried about 1 or 2 pennies necessarily. Okay, but you can see this theta is going to help me. This one's going to hurt me. So they offset each other. So picking the right duration, I could go in really close. But if we look out here and we see the theta is pretty much offset as well, then we can go out further in time and not have to worry as much about our duration. It gives us more time to be right. So when I look at this chart right here, this usually shows us, what theta decay does on the at the money call and the at the money put, which is what we are going to be working with here, is the at the money call and the at the money put. Let me just try and get up a different one because for some reason that one doesn't want to work for me on this particular one. Make sure I have on my thing there, get all this stuff set up. I got my pen. Let me just check it. Yes. So usually we have to worry about that theta, but remember, I bought this call, so the theta is going to hurt me, but I sold this put down here, so that theta, because I sold premium as it goes down, helps me. So I've offset these two. And if I have, why not go out here in time out here, and it gives me, the next 60 days to be right, rather than get inside of here and I only have, I have to make a quick move right away inside of 35 days to expiration, only because when it comes to zero, our options expire. That's one of the downstrokes of doing the synthetic long, is we do have only a limited amount of time. And if we only have a limited amount of time, we've offset that theta component that usually hurts us. Get out there. You will have to pay a little bit more money out here, but like I said, you have a ton more time. It's only going to be, maybe a quarter or something like that, but it's going to give you twice as long to be right. Picking the right strikes. This all comes back down to what we were talking about, is delta. All right? Making the strikes equivalent to the delta we want. We are going to try and set this up to 100 delta. If it's a really high flyer stock, you don't want it to overweight it, or you want to just get your feet wet with this, try and build it out to where it's a 50 delta, and then that's equivalent to 50, of the underlying 50 contracts. Why aren't I just writing? All right, contracts. All right, so it's up to 50 contracts there. All right. So that's picking the right strikes, is making it 50 delta. Knowing our exit strategy before entering the trade. Now, I don't talk a lot about this here in this video or these webinars on, entering and exit strategies. I mean, I talk about it a little bit more on the exit, but let's just say, for instance, I was going to look at Apple. Everybody looks at Apple and it's trading close to 100, so it's going to make my math easy on everything. It's in a bull trend. So this is one of those things where we were talking about, we're in a bull trend. It's a bullish market. We're bullish in Apple. It's got middle of the road, right around that 40, 50 delta, where it's not extremely low or extremely high. It's middle of the road. So, it could go higher or lower from here. Sometimes it goes lower, sometimes it goes higher. So we don't know what direction, or don't have a strong feel on where volatility is going to go for Apple. Therefore, I want to isolate what volatility does to my strategy or to my portfolio. I'm going to offset it by doing the synthetic long. So, knowing the exit. For me, I would say if I had a bullish assumption here, thinking it was going to break to here, my target would most likely be lining up with this value area high. I think it's going to vacuum up to $218. So to me, when I'm putting this strategy down on paper, I write down every single strategy I do, why I put it on, what all of these rules are. I check off my rules that we showed behind here, right? I go through, is it the right underlying? Is it the right environment? Is it the right duration? Picking the right strikes. I write all that stuff down. The picking the right underlying, XYZ stock fits that rule. It's 10 cents or less. The environment right now, around XYZ, it's a 42 IV %. Okay, I put that down. My duration is, I'm going to be looking at the 63 days to expiration. I write that down. Picking the right strikes. I made it 100 deltas. I'm bullish. Why am I bullish? Because Apple has a product that I think is going to send it to the moon and back. All right. And it's going to be very happy. So whatever. Or they've taken over who knows what. Streaming TV. I don't know. It's gotten rid of the cable company. Now I'm really bullish in XYZ stock. Whatever my assumption is, why I did that. And on the downside, where am I getting out of this strategy? Where am I going to? Because remember, this is acting just like a stock. It can go to zero. I have to worry about all of those things. So on this, I think it's going to go to, I've got the wrong marker up. It's not going to give me any love with this one. So let me get back to I've got a bunch of different things going on here. So let's give me my marker over here. So I said, okay, I think it's going to go to 218. I wrote that down. I think it's going to go to 218. But if this rolls over and breaks the 78 Fibonacci, all right, it breaks the 78% Fibonacci, then I'm out. So if it goes below here, I'm going to be pulling the ripcord on this strategy, right? So I know where my highs and lows are. If it rolls over here, breaks this level, the 78 Fibonacci, I'm out. I write all of those things down so that when we see it happen, I'm out. Okay, so write all that stuff down on a piece of paper or on your computer somewhere so that you have the data to go back and look at to see if you were right or if you were wrong. All right, I'm going to pull up a couple examples here real quick. Give me one more second. Now remember, our profit is infinite, just like with a stock. A stock can go to $1 million and beyond. It's not going to happen in our lifetime, but just know the profit margin, just like a stock, is infinite. With this, it's infinite. Our max loss. Now, normally we talk about if you pay a debit, right? Anytime you pay a debit, you know what your risk is. You know what your reward is. With this one, our risk is the underlying goes to zero. So if it's a $100 stock and it goes to zero, I've lost all $100. Okay? Just like as this $100 stock went to, $100,000 million, then I've made it from 100 to $1 million. I've made $999,900. Okay, so if it goes that high, if it goes to zero, I've lost all 100. All right, it's not the same. Credit and debit with this strategy is a little bit different. It's the only time you really see that difference. All right, and then finally, we need to know what our break even is. All right, so break even is the call strike plus the debit or minus the credit. All right, and we're going to figure that out. So if XYZ is trading 100 and I'm doing the 105 calls, right? And those 105 calls are going to probably cost me, with this entire strategy, it's probably going to cost me, receive, you're going to get a credit of maybe $5. Okay, so now, our break even is 100. If it's debit, let's just say I paid a debit, then we add it in. So in that case, I'd be looking at the 95 calls, and I paid a debit of $5. That would make it equivalent to the underlying. Okay, I'll show you some examples of that. But basically, call strike price minus the credit or plus the debit. It's pretty simple. All right, let's pull up the trading platform, start building out some strategies. So this is usually where I throw it out to you guys. We're going to look to build a strategy here to try and fit these different market assumptions that we've got going on for a bullish bias. All right, so we'll start playing around with some of those from here. All right, somebody wants to see the Apple trade that we got up here. That makes it simple. So let's look at Apple. I'm going to go further out. Remember, my rule here, though, is picking the right underlying, okay? So our underlying is Apple, and it is trading at $200. So move the decimal 3 ticks to the left, 20 cents wide. These are 10 cents wide on the ones that are closest to expiration. Now, I want to go further out in time because I want to get to a point where I have enough time to be right. It's trading at right close to $200. You can see here, 50 deltas. I'm buying those. So that gives me 50 deltas, and I'm selling these. All right? That negative plus a negative is positive. So positive delta 50 minus 50, that gives us 100 deltas. Now I want to show you something. We've got 100 deltas here, 100 deltas there. Let's analyze this trade. Now you can see I've got XYZ for my stock. You can see the purple is the underlying and the purple is the underlying and the blue is me. They are laid right over the top of one another. So that shows you, for one, it is going to perform exactly the way the other one did. All right. So we can see that that is what we want. We've added up those deltas. Look, we're off by a very little bit, which is why you can kind of see it. And the further we go away, like I said, if we started out with these, we're 50-50, and now all of a sudden the market's moved in our direction, and let's say, it's moved from $140 to $200. You can see here we have 92 deltas. Over here, we only have 1 delta. So we've lost a few deltas along the way. All right. And that is going to be something you're going to see. 68. And we have a total of 99 deltas. So we've lost a penny if it moves up by $10. Okay. I'm not going to be in this strategy much longer than that kind of move, right? It's a day trade, or not a day trade. It's a short-term trade that we're looking for a bounce to happen. It's not something I want to put in my portfolio for a very long time. So I'm going to be looking at this for a very shorter duration. But you can see here, we got the 50 deltas. Everything works out quite nicely on this one. I bought this strike. I bought these calls. So I am plus 50 deltas, right? And I've sold these. So I've sold these puts. So I'm selling a negative delta, makes those positive 50 deltas on that. Now, we could look at this where real quick for the risk reversal as well. I talked about this. We want to try to go to about the 25 delta. You can see we don't have the 25 delta. So it's kind of a pick 'em. Do you want less probability and more risk? So this would be buying that one and selling those. So we can see, oops, let me sell those. I sold 23 deltas, bought these. You can see that I only have now 46 deltas. So it's slightly less, but it is half of, what I was doing before. So that's a risk reversal, but it can also be a synthetic long with half the amount. If you're used to trading $50 stocks or $100 stocks, you're stepping out. All of a sudden, you're doing Apple, and you're doing those $50, $100 stocks one time each. This is equivalent to 100 of the underlying. Well, I only want a little bit less Apple because I don't want it to overweight my portfolio. This is how you would do it. Now you only have 50 shares of Apple synthetically in your portfolio. Okay? So pretty simple there. We just add up those deltas. Yes, you can use the weeklies. You can use this on ETFs. You can use this on futures. It all is the same thing. Just make sure your deltas add up to be equivalent. You can see here a 60 delta, the 40 delta, that I could have done the in the monies. So on this one, let's look at it. We looked at Apple, and let's go back to the very beginning one. So the 50-50, right? So we're talking about this for every price. We got $200 delta. Now, I've got a 77-cent credit. We talked about this, that if we have our break even is our call strike price minus the credit received. So we've got $200 right here. So we've got the $200 call, and it really doesn't matter because we're using the same calls in the puts, right? But we've got the $200 call, and we're paying 77-cent credit. So we subtract that 77 cents out of here. Now our break even is going to be trading 223. So when it's trading 220, subtract this out. It's the $200 call. Let me start all over here. I got a little ahead of myself. So we've got the $200 call, right? We've got those $200 calls. We're receiving a 77-cent credit for it. All right, so we have to subtract this out. So now we go down to the $200 call. We subtract that 77 cents out of it. So now when it's trading 199, 77 cents, remember, 190, what is that, 23, that's our break even. All right, 199.23. You can see we are slightly paying up on this. You will a lot of times see this where you can build this strategy out where you're actually buying it below where the underlying is. Right now we're paying a little bit higher, okay? But let's get rid of that and just look at it from the put standpoint. If I bought this, sold that, we still got the 100 deltas, 60 and 40, right? Plus 60 deltas, minus 40 deltas. That's a total of 100 deltas on the underlying if we're doing one contract. If I did 2 contracts, that's 200 deltas. 3 contracts, 300 deltas, okay? So it's equivalent that way, a multiple of the quantity. But what happens now? We paid a debit. So remember we said with this strategy, with a debit, if you get a debit, you add in the debit. So now we've got the 195 calls, and we add in $4.25. So now when the underlying is trading 199.25, that is our break even. All right. So we still got to make up a little bit more room to the upside. But at the end of the day, we're paying a lot less in margin. I can go over here and show you on this. What's to say that I came out and bought 100 XYZ. 100 XYZ, 199.74. Let's just look at the create opposite order. Or actually, I don't want to create an opposite order. I just want to buy those and do it as a synthetic long. Let's just do that again. Buy those. I I actually want to confirm it. So let's confirm it. And you can see it's, it's a $200 stock. I got 50% margin. So it's half of that. It would normally cost me, for 100 contracts, $20,000. Cost of the trade is $20,000. My buying power effect is half of that. Okay. Because I've got 50% margin. Now, if we did it with a stock, let's just say we're going to buy, let's do it with the $200. Buy that one, sell that one. We've got the $200 stock. We want to make it equivalent by making it a one lot like the other guys. Now let's just look at creating an confirm and send. Actually, you can see that my buying power effect is going to be much less than that. All right. I don't know why my buying power effect on this one is showing it as, should be like $2,500. Not sure why that's not showing up right correctly. I'm going to buy this one, sell that one, and make it a one lot. Should be close to, because that's, yeah, $5,000. I'm sorry. $5,000 because it's not a $100 stock, right? It's a $200 stock. So you can see, though, it is half of what the margin was. The other one was close to $9,000. This is half of that even, right? If you did it on a normal stock, basically your max loss and what you would have to pay for it is that $200, okay, or $20,000 for a $200 stock 100 times. Does that make sense so far for everybody? You guys are on this one. This is a relatively easy one to learn if, you don't have anything else to go on. I make it a little bit more difficult. It's not just that easy to come in here anytime and just buy it. If it's super high implied volatility, yes, we can offset all of those negative effects that volatility is going to do. But with buying a stock, anytime you buy XYZ stock, your chances are 50-50 probability of success. The market has a 50-50 probability of going up or down at any given time. This stock is the same way when we set it up as a synthetic long. But if I'm using options in a different way, especially for high implied volatility, I can increase my probabilities of success much greater. Just like I talked about, if you can get this volatility coming out, why wouldn't I sell puts? And then if I was directionally wrong and the market went down, I would still be okay. All right. So that is something we can take advantage of. All right. All right. So any other questions so far? It's pretty simple. I mean, we tried to build it out to where we have 100 deltas, so it's equivalent to 100 of the underlying. That's for every one lot. If you did a two lot, then it's 200 deltas, right? There's no reason to do the 25 delta and make it 50 deltas and do two of them. Why not just do it correctly, right? So I would do that. And the other reason is you do have to be with the risk reversal a little bit more right on that one to get that bang for your buck. Okay? All right. Nobody else has any other questions. Without further ado, I'm going to throw it out. This is the strategy, or these are what we are giving away right now, is the 2-for-1 deal where you can get the floor trader hacks. This is going to streamline your process, okay? Before, you might spend time and effort trying to figure all this stuff out, right things to look at before trading options, the 9 trader hacks. I gave you one of them with the delta. We were talking about that. Things that you can learn from real floor traders, okay? Little tricks of the trades that I've learned, how to trade your money and knowing exactly where your probabilities are. That's hugely important. We do this for $4.95 or $4.97. We also got this is streamline your process. This is Lean Six Sigma kind of. And this is so you can get your Z's at night. You can sleep at night for $4.97. We got the Volatility Crush. It tells you everything that you need to know about how volatility is going to affect your premium. You will not have to worry about all these things. Am I doing this right? That's the thing I try to teach here, you guys, is making sure that when you guys are doing all of this stuff, that you are streamlining your process, that you are confident when you enter. Because if you are confident when you enter, you know you're doing the right things. You're not second guessing yourself. You're not worried about the trade. You're not trying to get out too early. So we're going to give both of these to you guys for the 497, if my pen will still work. We're going to give you guys these both for 497. Okay, so you get all of this and all of this for 497. So 2 for 1. And the link for this is going to be in the chat window. I've added it to the chat window, but if you are watching this on tape delay, you're going to have to punch this into your URL or call us at 310-598-6677 or email me at trading@protraderstrategies.com. If this link isn't working, I think I copied this in there possibly wrong. So please reach out to us because we don't offer that deal. We haven't ever offered this deal, and it is for a very limited time. So if you want to be able to streamline your process, Lean Six Sigma, and get to sleep at night, we're giving you both of these two strategies for $497. And if you can't type this into your URL and get it to work, please call us at 310-598-6677, and I will get you set up with that straight away so you don't have to worry. And you can always email me at trading@protraderstrategies.com. Please follow me on Twitter and our Facebook page at Pro Trader Strategies. We're going to be doing all kinds of live videos. If I just come up with some kind of crazy thought that I think is going to help you guys out on a trading basis, I'm just going to throw it out onto Facebook. You guys will get a notification. You'll be able to watch that, all right? So check us out there. Follow us on Twitter, Facebook, all of that good jazz, because we are going to be doing a lot of live video and adding a ton of new content on YouTube as well. So you can follow us there. That's usually where most of our videos originally get uploaded to. All right? But watch out for those live videos and podcasts, all right? That's all I got for you guys, other than if you can't take that, take it easy. Take care, everybody. Bye for now.